in businesses per se. Let's put some of these factors to our guest who's joining us now. Andrew Holland is CEO at Avendus Alternate Strategies. Andrew, great to have you with us here. Thank you very much. I mean, so that first question is, of course, how far does this bounce go in your opinion? What are your thoughts?
It might have a few, still a little bit more to go, Prashant, but, I think you've summarized it well in that the dilemma for markets, which will continue to kind of keep it volatile, is, in the first part of what you said was, the hope that, recession might be on its way, so therefore, the Fed might not be as aggressive. And on the second part, you mentioned that, China reopening. Now, if China reopens, I would have thought that would kind of, again, have an extra leg for commodity prices, including oil. And therefore, we go back to, inflation's becoming, more aggressively higher than we were thinking a week or so ago. So that's what the market's going to grapple with. This is what I really think, despite what I've just said, is that the Fed will have to increase rates by 50 basis points for the next two meetings at least, to say that they're on top of getting inflation down. I think anything beyond that would just seem, as another turnaround, another U-turn by the Federal Reserve Chairman, and I don't think that would bring any confidence to anybody. And I think the second thing which I think we're going to have to grapple with over the next coming months, as the Fed starts to tighten the balance sheet, is what unintended consequences that could have, because liquidity, as you remember all of last year, kind of buoyed up all asset classes, from equities, bonds to all asset classes. Now, without that liquidity, are there any kind of problems which have been swept under the carpet about to fall out from under it? And maybe we're seeing that partly in the crypto market at the moment, in terms of cryptocurrencies. Maybe there's something there. Maybe there's something financial which will spook the market. So I think it's something we have to be aware of. I'm not saying it will happen, but if you look at the trailer was China, right? It increased rates in 2021, and for the unintended consequence to be that the property market took a very big hit, and a number of leading construction companies, really defaulted on, or did default on, some of their bond payments. So I think that's the worry I think the market might have to kind of think about over the summer months.
All right, we get that point, but the way the world is moving right now with regards to the equity space, there has been a fair amount of risk off, so to say, people looking at debt again, and valuations aren't particularly cheap, even though we've seen a fair amount of correction from the top, and that's primarily because a lot of the estimates have been revised downwards as well. In a situation like this, what do you think one's strategy should be in the medium to long term, notwithstanding the near-term volatility?
So I think, first of all, downgrades have still yet to take place with full force in India. I think the next quarter you'll start to see more of them. I think what's happening, globally is that share prices are taking the hit first, and then you're seeing the earnings downgrades later. Or if it's a shock to the market, which we've seen with a number of retailers and the tech companies in the US, then they're being hit quite hard, and it's happening here in India as well. So I think we'll see more downgrades by analysts. I think, given what I've said, one of the asset classes which people always tend to forget is cash. And in volatile times, protecting capital is not a bad asset class to be in, to let the dust settle. So, unless you're very happy with this kind of volatility, then I would say, for the next few months, just protecting your capital, keeping some cash aside, is not a bad strategy in the very short term. I think longer term, once whatever plays out, and I would suspect that the Fed will stop hiking rates by October of this year, and we could be looking at a very different scenario, and that's when I think the risk on trade will happen, and we won't be talking about inflation, but with commodity prices falling as aggregate demand starts to fall globally, as Europe and UK will be in recession, and the US skirting it, that would be kind of the time when the Fed will look to kind of go on hold, and there'll be talk about interest rates may be kind of falling in 2023. That's the risk on trade. That's the kind of not deflation trade. It's probably like that. You'd be looking to play towards the end of summer.
Do you have levels in mind, Andrew, in the interim before that turn, that switch happened that you described later this year? Where does the market get to? I mean, the Nifty, for example.
So let me put it in two parts, Prashant, because it's a good question. In that, for what we know now, if the market, so I'm talking about the Nifty now, was to go to those levels of 15,700. I know whenever it goes there, everyone starts talking about 14,000, 14.5. That's a good level to my mind to start picking up the market, and that we've seen it bounce from there. If we had any unintended consequences, then you would see the markets fall maybe another 5% lower from the levels I've just mentioned. That's the kind of thinking we have at the moment. So
or 15,000.
Recent lows, if there's no
15,
yeah, if you have unintended consequences.
Okay.
Yeah.
Okay. So
15.7 is what we know now, and
sure.
Yeah.
All right, and you believe it can at any point, at some point also perhaps if it continues its downward slide, go to all the way low to 14,500 as well. That'll be interesting if that happens, and Andrew believes that is the time when the markets would begin to look attractive. But beneath the surface, a lot of the stocks are actually at levels much below 14,500 on the Nifty, particularly in the mid-cap end of things, Andrew. Let's talk about sectors then. The metals sector was the worst performing sector this week. Do you think the best for the metals is now over and the cyclicality has turned towards the obverse side?
I do, because if central banks around the world are trying to bring aggregate demand down, then obviously you're skirting recession everywhere, then commodity prices will fall. That's for sure. So you might have a bounce from the bottom if markets are kind of or the growth prospects are looking a little bit kind of more brighter in the very short term. But otherwise, I think commodities will remain under pressure for most of this year. So that's not the trade I'd be looking for. I'd be looking for who's the beneficiary of that, and obviously autos would be one of them.
That actually, you second guessed my obvious follow-up to that as well, which was the auto space, which tends to benefit from lower prices. So you are positive on the auto space, but then what happens to demand? Because inflationary times also means that people don't consume as much, and maybe put off their purchases of a car. Higher interest rates would make the cost of ownership of a car a lot more higher. You have higher fuel prices, etc. as well. So would you just play it for lower commodity prices, or is there any fundamental, reason to buy auto stocks?
Yeah, no. Listen. We'll still, there'll still be demand for cars, but let's just say that the demand level remains as it is today. But you've got lower input prices, your margins go higher. So it's an easy way to think about. For the auto companies, will make more money. Even if demand doesn't pick up significantly because of higher interest rates. If it remains as is, but your input costs are lower, then your margins get higher. So that's what I think the market will like. And of course, we're only talking about this year and next year. I would expect a big capex cycle to pick up global GDP growth going forward, and that would, along with the risk on trade coming back, this is where you're going to find favour. Foreign investors will come back, and I think autos will be one area that they'll be looking at as a longer term consumption play in India anyway, and with lower input prices.
Talking about what you would short is always more fun, Andrew. So let me ask you. 3 top short ideas.
So I think on the short side, commodities remain, I think one where you can look in the very short term to continue that. I'm still not convinced on the banking sector. I know it's had it's bounced off the bottom, but I don't think it's. I just don't think it's an inflation play in India at all. With higher rates coming, I think demand for credit is going to going to fall off fairly quickly because of that. So I'm not a believer in banks at this moment. And I think so I want to switch to the other side of the kind of from shorting is the reopening trade in terms of sectors continue to be something which I think will be a big beneficiary as people keep moving around in India and spending. I think we all know how difficult it is to get restaurant bookings at the moment. It's a very